Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Please like this video and send it to your stupid financial advisor. We're going to be talking about the index apocalypse today. The S&P 500 is a towering Jenga stack built by an over-caffeinated toddler, except the bottom 490 blocks are hollowed out husks, and the top 10 blocks are made of plutonium-priced tech dreams. Every paycheck funneled into your 401k is another gentle nudge on that wobbling skyscraper, and you are just cheering while it sways. We have an economy where zombie corporations shuffle around on borrowed IV drips of low-rate debt, begging for last refinancing hit, while passive funds strap rocket boosters to their rotting backs because the algorithm demands market weight. And we have the M2 money supply printing faster than a Red Bull-soaked frat boy at a photocopier. So your glorious nominal gains that you get from the S&P 500 are literally just fluorescent ink on rapidly shrinking toilet paper. If you're still bragging about owning the market, congrats, you are the proud landlord of a condemned apartment complex, and the tenants are setting couches on fire to stay warm. Tonight, I am going to torch the myth of diversification, salt the earth around it, and then pivot to assets that are actually alive, scarce, and hostile to monetary decay. Buckle up. This roast is served extra crispy. Before we get started, a very special thanks to Horizon for sponsoring this video. Guys, Horizon helps you buy Bitcoin using your home equity without debt, monthly payments, or term limits. The Bitcoin is fully yours to custody however you want, with no risk of forced liquidation. They're linked down in the video description below. I'll talk more about them at the end of the video. Let us begin with a magic trick. I present the S&P 500, a box that claims to hold 500 distinct companies. Watch closely. I remove the lid, and surprise, 99 cents of every diversification dollar has been teleported into the pockets of just 10 mega-cap companies. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, Broadcom, Berkshire, JP Morgan. That is the decouplet. Together, they weigh in at roughly 40% of the entire index. That is 40 cents of every retirement dollar bet on 10 stocks that all share the same macro diet: global supply chains, intangible code, and buyback protein shakes. Cast your mind back to the turn of the millennium. Do you remember those good old glory days during the dot-com mania? The top 10 captured 25%. Now we're sitting at 40%. We have added 15 extra percentage points of concentration, yet Wall Street still calls this a broad market proxy. Imagine a Las Vegas buffet where the dessert bar now occupies 40% of the dining hall and the salad section is a single wilted leaf. That is the modern index. Now observe the equal weight sibling, the version that gives each company 1/5 of 1% slice regardless of size. Since October of 2022, that egalitarian cousin has trailed its celebrity brother by 21 percentage points. So, same constituents, different weighting rule, and that gap in performance is proof that the other 490 names are a ballast, decorative sprinkles, fine print at the bottom of a pharmaceutical ad. Adam, why does this matter? Well, first, the autopilots flow. Roughly 80% of US equity dollars now arrive via passive vehicles. They do not analyze price to sales or free cash flow. They just match the float. When Apple gets more expensive, the index just buys more, which is circular logic at very high speeds. So the entire decouplet, the top 10, they just ride a conveyor belt of compulsory demand while the remaining firms just beg for crumbs. Second, there is fragility that is hidden by the scale of the index. I want you to think of a circus pyramid, 10 elephants on top of the pyramid, 490 clowns beneath, each wearing roller skates. Should one elephant twist an ankle, say a regulatory fine, an AI misstep, or a factory fire, the entire pyramid becomes an accidental study in gravity. The clowns cannot catch the weight of 10 elephants, kids. their combined market share is too small to cushion a $1 trillion wobble. This means that there is a broad valuation distortion. What do I mean by that, you ask? Well, the median price-to-sales ratio of the top 10 hovers near 10. The median of the bottom 490 sits around 2. When investors buy the index, they pay Ferrari multiples for a fleet that is mostly used pickup trucks. They just do not see it because the Ferrari floor mats cover the rust. Fourth, we got to talk about monetary plumbing. Index construction committees rebalance quarterly. Between the meetings, the capital flows obey yesterday's weights, amplifying the extremes. So momentum just masquerades as fundamentals. If momentum reverses between the rebalance dates, losses propagate on hedge. You are not diversified, you are delay hedged. Consider also sector overlap. 8 of the decouplets inhabit tech or tech-adjacent services. Supply chain bottleneck, tax overhaul on intangible income, 1 policy tremor, and 8 knees buckle at once. Correlation shoots toward 1, diversification dies, portfolio value reports to the emergency room. Now, I have a lot of listeners that are of older age, so let me translate that into retirement language. You thought that you were spreading risk across 500 different harvest fields. In truth, you are betting the farm on 10 plants, all in the same greenhouse, all fertilized by the same central bank sprinkler. If the greenhouse roof cracks, the other fields are too small to feed the family. Therefore, next time someone chirps, just buy the market, I need you to remember the magician's sleight of hand. 500 names on the marquee, 10 actors on stage, 490 seat fillers, waiting for a line that they will never deliver. Diversification became a costume. Concentration wrote the script. My advice, do not clap for the show. Check which actors are bouncing on the safety net and consider leaving before the elephants come crashing through the orchestra pit. But remember, this is not financial advice. This is financial entertainment. Now that I have stripped the mask off the stupid thing called diversification, let me pry open the cellar door and meet the house guests, which are America's undead corporations. In finance, a zombie is a company whose operating earnings can't even cover the interest on its own debt. Think of a restaurant so broke that it maxes out the company Amex card just to tip the waiter who served its last bankruptcy meal. Globally, there are around 7,000 of these lurkers, but closer to home in the United States, there are about 2,000 U.S. listed firms now qualifying for zombie status, which is roughly 1 in 8 tickers. Their business model right now is very simple. Borrow, breathe, and repeat. They shuffle forward, powered not by profits, but by refinancing windows and the faint hope that tomorrow's coupon will somehow be cheaper than today's. Higher rates? Well, that's like raising the sun on a vampire picnic. Let me inflate the horror with hard numbers. U.S. non-financial business debt sits at $21.9 trillion as of Q2 2025, which is roughly the size of the entire US GDP in 2002. Yes, corporate balance sheets are wearing debt like they are medieval plate armor, which is very impressive until you try to swim. And then there is the shadow realm, private credit funds. Once a niche for distressed specialists, they now own about 9% of all outstanding corporate IOUs. Think of them as the loan sharks in pinstripe suits. No deposit insurance, no mom and pop projections, just covenants written in invisible ink. So when a downturn hits, these creditors won't call a friendly regulator, they'll call legal, and legal always eats first. Lurking just beyond the calendar's edge, fellas, is the 2026 maturity wall. About $9 trillion in treasuries must roll. The refinancing queue is literally going to look like a Black Friday outside of a bargain coffin outlet, except the price tags keep rising while the merchandise keeps rotting. But wait, there's more. Let's talk about entropy, one of my favorite topics. Over the last decade, ultra-cheap borrowing let these company executives gorge on share buybacks. They have engineered growth by slicing the shares outstanding pie thinner the same way that a pizza parlor advertises bigger slices by using a sharper knife. Unfortunately, interest payments don't shrink just because EPS optics improve. Now, higher coupons force management into a very grim dilemma: cut buybacks and disappoints momentum traders, or keep guzzling debt and risk joining the living dead index. So let's stack the bodies, okay? A zombie with 4% cash flow margins running 8% coupons needs sales to double just to stay put. That's correct. A zombie with 4% cash flow margins running 8% coupons needs sales to double just to stay put. Yes, that is the simple math. That's before taxes, capex, or the flood insurance premium on the headquarters of the company that's currently situated in a 100-year flood plain that seems to arrive every other Tuesday. So the index that you have thought was a retirement hammock is in fact a zombie carnival funded by IOU gasoline and spun by passive flow centrifuges. When the music stops, rate shock, credit event, regulatory kneecap, whatever it is, the undead don't politely sit. They collapse face first, taking the index in your balanced portfolio down the staircase of falling knives. In short, we're not talking about healthy firms weathering temporary storms. We're talking about a legion of corporate corpses kept ambulatory by intravenous leverage, hiding beneath the glitter of 10 mega caps and the marketing slogan of low-cost diversification. Invest accordingly or bring garlic. Gather round for the grand reveal of Wall Street's favorite street magic act, turning fiat confetti into record highs. From January 2020 to December 2021, our trusty M2, which is the US money supply, it exploded. It swelled 39% in that very short time horizon. That is not just a gentle expansion, kids. That is injecting a hippopotamus with espresso and wondering why the pool overflows. And the S&P 500 dutifully sprinted about 90% higher from that same 2020 baseline. Cue the champagne, right? No, hold that cork. When you adjust for the ocean of new dollars sloshing around in the system, half of the index's glorious climb is just buoyancy from the rising tide of fresh ink. Strip away the fiat flotation device and your broad market triumph shrivels to 30% real advance. Over 5 years, that is the equivalent of jogging on a treadmill while the floor itself is being pulled forward. Sure, yeah, the scenery is moving, but you never actually leave the gym. You want another metaphor? Okay, the S&P 500 is a hot air balloon, and the Federal Reserve's liquidity hoses are the flamethrowers that are cranked to max. The altitude gauge on your hot air balloon looks very heroic, 9 miles high. Sure, if you jump out, you might die. But then you realize the ground level rose 6 miles under your feet. Congratulations, you're still 3 miles off the deck, but you paid 9 miles worth of risk premium for the privilege. Even worse, your dividends, the one consolation prize that the passive investors still hug at night, they arrive in the same diluting currency. It's like being paid in ice cubes while the thermostat crawls toward a heat index of perdition. Now, the inflation pickpocket is very polite. He doesn't rip your wallet out. Instead, he gently replaces every crisp bill with a slightly smaller twin and then just sighs, "Trust me, the number on the paper matters more than the paper itself." And then you're out there chasing nominal gains that sizzle on contact with grocery aisles, rent renewals, and tuition invoices. All of these clowns in traditional finance are tuned into CNBC. They're watching Jim Cramer trumpeting another all-time high. It's a mirror at a circus funhouse. Yes, you appear 8 foot tall, but only because the glass has been stretched by 8 trillion new printed dollars. Real wealth creation isn't a number marching northeast on a chart, kids. It's purchasing power standing still while the currency treadmill tries to yank it backwards. The moral of the story: if your investment strategy celebrates the nominal highs without measuring the monetary quicksand beneath, you are applauding the magician while he saws off the floorboards under your seat. The rabbit is your retirement, and it never makes it back out of the hat. Up to this point, my critique has lurked in spreadsheets and bond covenants, but now let me yank the S&P out of its Bloomberg bubble and drag it kicking into the meat space, where concretes crack, supply chains snap, and Mother Nature periodically flips the game board just to remind us who owns the property rights on planet Earth. First stat on the chopping block: the global insured natural catastrophe losses have smashed through the $100 billion barrier 4 years in a row. That is the worst losing streak since the actuarial equivalent of the Cretaceous extinction. Insurers right now are basically printing "you must be kidding" endorsements at this point, while the CFOs of the coastal real estate investment trusts sleep with inflatable life vests under their beanbags. Zoom in 2023 America. Do you remember 2023? I do. Great year. Just kidding. Our beloved heartland of distribution centers and suburban data barns and Dollar Trees. Severe convective storms. Remember those friendly tornado hail mashups? They produced 18 separate billion-dollar events. 18 different Godzillas absolutely destroying your country in a single calendar year. Congratulations, index investor. You now own the buildings that Godzilla has stepped on. Next is the MSCI's July 2025 stress test. Under a disorderly 2-degree climate trajectory, which means the politicians keep haggling while the thermostat climbs, of course, the median S&P firm faces double-digit cash flow at risk. Not the outliers, not the tail risk fringe, the median. That's like discovering the average burger at your favorite diner contains a mystery meat that may spontaneously combust during grilling, but hey, the ketchup is free, so bon appetit. Let me get granular. Let's talk about supply chains for a second. The index is overweight to technology, retail, auto sectors, yes, that treat the just-in-time logistics like their oxygen. Yet maritime choke points are tightening, drought shrinks river traffic, and semiconductor fabs guzzle water faster than Vegas fountains. When a single Taiwanese reservoir sneezes, your diversified retirement account catches pneumonia. Water stress? Well, fun facts for you. Over half of the S&P's physical assets sit in regions trending toward chronic scarcity. Kind of hard to run a thermonuclear chip plant or an Amazon fulfillment center the size of Luxembourg when the municipal faucet coughs dust. Geopolitical flare-ups? Well, the Red Sea and Panama Canal love to audition as chaos theaters. If you've paid attention to any 20th and 21st century history, one stray missile, one stalled mega tanker, and suddenly your cost of goods line item reenacts the jump scare at the end of the Blair Witch Project. Now, corporate risk disclosures do mention these threats. Absolutely, they do mention them in the same way that airline safety videos mention uncontrolled descent while a cartoon cloud smiles in the background. Investors click accept all and move on because spreadsheets model volatility, not debris fields. And remember, the passive flows keep hoovering up these index constituents no matter how high the floodwaters are. No dynamic risk adjustment, no climate triage, just a blind ritual of market cap equals buy cap. It's like insuring beachfront condos by counting square footage, ignoring the fact that square footage is slowly migrating into the Gulf of Mexico. I'm sorry, Gulf of America. You need to realize that intangible software margins cannot levitate forever when their physical server farms sizzle under heat wave brownouts. The ESG scorecards aren't gonna douse electrical fires, they're corporate mood rings. Hard assets still obey the laws of physics, kids, and physics do not accept deferred tax credits. So So the S&P 500 is not just a surefire concentration bet on 10 megacorps at the top. It is also a bingo card of supply chain rupture, flood insurance requotes, drought-driven capex, and storm season inventory write-downs. Investing without accounting for real-world entropy is like bragging about your perfect chess opening while the termites are eating the board. The index is whistling past a meteor shower in a convertible. If you insist on staying on for the ride, at least keep the top up and the emergency radio turned to the NOAA. Everyone else, maybe consider assets that store value in cyberspace rather than steel-girt warehouses parked on a floodplain shaped like a bullseye. Time to leave the Roach Motel of these debt-drunk equities and meet the indestructible cockroach deity of money, Bitcoin. 5 years ago, October 15th, 2020, right here, kids, feast your eyes, the price tag on Bitcoin was a very modest $11,537. If you fast forward 5 short revolutions around the sun, that very same shard of code fetches a $111,331. That is a neat 10x in nominal terms. Yes, a nice little 10-bagger. And it is a 58% compounded kickflip each year. Yes, that is the CAGR, 58% growth over 5 years, which is handily beating both the S&P 500 hamster wheel and the Fed's monetary leaf blower. However, raw price is only the appetizer. Bitcoin is a monetary species engineered in a digital petri dish with a fixed population of exactly 21 million. No share buyback gimmicks, no dilution by congressional blinking contests, just immutable scarcity baked into math that would survive a supernova so long as one nerd remembers the seed words. Self-custody, you are literally your own bank, an anarchist piggy bank made of cryptographic adamantium. Thieves can break into your house, but they can't brute force prime numbers before the heat death of the universe. Try getting that guarantee from a broker whose idea of cold storage is a fire hazard server closet behind the cappuccino bar. Let's talk correlation real quick, kids. During most market panics, Bitcoin marches to its own tribal drum with an equity correlation floating around a 0.2%. Just enough independence to flirt with chaos without marrying Wall Street's neuroses. When the S&P screeches because some mega cap CFO sneezed in Mandarin, Bitcoin often yawns, checks its block height, and continues its sovereign journey through digital cyberspace. Bitcoin is an all-you-can-eat buffet where the chef slowly welds the serving trays shut. Everyone's hungry, the food is disappearing, and you're sitting there hoarding the last slice of digital cheesecake. Of course, volatility is part of the romance with Bitcoin. Bitcoin is an adolescent dragon discovering its own fire breath. It occasionally torches 30% of its market cap in a weekend just to remind the hodlers that freedom isn't free. But zoom out to a 5-year candle chart and those fiery tantrums look like pixel dust. So let's juxtapose them, kids. The S&P lumbers along with zombie leverage and climate roulette, while Bitcoin, a pure creature of code, compounds like a radioactive sunflower growing through concrete. One asset relies on quarterly guidance sprinkled with hope and buybacks. The other relies on SHA-256, a cryptographic bulldozer that hasn't blinked once in 16 years of uptime. In a world where liquidity fountains turn dollars into wet tissue, Bitcoin is the cockroach that not only survives the nuclear money bomb, it waltzes out of the fallout shelter, wearing a crown of block rewards, holding your purchasing power hostage in plain sight. Choose wisely whether your future wealth rides zombie spreadsheets or a dragon made of prime numbers. Now, if you want to talk about risk, let's talk about strategy, also known as the ticker MSTR, the corporate treasury that is just dominating the entire equity space. Michael Saylor decided to buy 640,000 Bitcoin, and the equity is up 2,000%. Michael Saylor is Captain Ahab, harpooning whale after whale, except his harpoons are convertible bonds and ATM share issuances instead of iron spikes. Critics are mumbling about the MNAV multiples at roughly a 1.3x, 4x MNAV today. Strategy is trading like a call option on both Bitcoin price and management's ability to harvest the capital markets. That premium is not detached from reality in the slightest. It is payments for Michael Saylor's genius talent at turning equity float into a perpetual motion Bitcoin hoard. Think of it as the management fee that you are paying where the deliverable is exponential scarcity. Compare this machine to those companies. What is Strategy's business model? To utilize the capital markets to increase your Bitcoin exposure. Zero physical risk, yet the best performing equity. Incredible how that works. Isn't that a funny relationship, how that works? I know, it's mind-blowing, right? Compare this machine to an ETF out there. The ETF passively mirrors price, and then they skim a management fee. Strategy actively arbitrages the capital markets, they amplify your Satoshi per share, and then they hand you embedded optionality on enterprise software. One is a mirror, the other is Tony Stark's arc reactor wired to a cold storage vault. Strategy is a Bitcoin devourer hiding in plain sight on the equity shelf, using Wall Street's own debt and equity playbook to cannibalize supply before the crowd has even figured out that the menu has changed. If you want equity exposure that scales with Bitcoin and has also greatly outperformed Bitcoin over the last 5 years, congratulations, the Kraken is already listed. Just mind the tentacles. Now, when we compare all of our options here, the S&P 500 Bitcoin strategy, what should a rational mammal do? Option 1, you can keep feeding the index or hope the top 10 companies never stub a toe on regulation or typhoon season. Option 2, you can move your stack into Bitcoin, the only asset whose supply schedule looks like a shrinking ice cap in reverse. Option 3, you could bolt some of your portfolio onto the equity rocket that is Strategy. Then maybe when they get an S&P 500 inclusion, you could watch those passive index funds funnel liquidity into your position every quarter voluntarily, so Saylor just buys more Bitcoin in perpetuity, creating the ultimate infinite money glitch. The real fact of the matter is that diversification is now choosing between mall food court calories and a cybernetic steak cooked by cryptography. The exit doors are very clearly marked at this point. One of the doors opens onto a carnival of zombie popcorn vendors. The other two lead to block time and bell curve shattering alpha. Cash out of the clown show, okay? Switch your chips to math, ride the Kraken if you crave leverage, and leave the passive index Dave Ramsey pilgrims to argue over which hologram flavor of risk they prefer in their lukewarm mutual fund slop. For the love of God, this is common sense at this point, okay? My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please send it to your incredibly stupid, idiot financial advisor. I know he probably won't watch it because Bitcoin renders his job obsolete anyway, but you'd be doing the world a service. Have a terrific day, my dearest little goblin rat captains. Class dismissed. Once again, a special thanks to Horizon for sponsoring this video. Most people don't realize this, but on average, 60% of American homeowners' net worth is locked up in their primary residence. And with home prices more inflated than ever, Americans now sit on a combined $35 trillion in home equity. Now there is a way to unlock that trapped capital and put it to work in Bitcoin. Horizon helps homeowners unlock a portion of their home equity to buy Bitcoin. It is not a loan, so there are no new monthly payments. You keep living in your home as usual. Later, when you sell, refinance, or choose to settle early, Horizon's provider takes an agreed share of your home's future value, and that is the trade. Unlock cash now to stack Bitcoin by selling a slice of your home's future value while you just continue living in it. What makes Horizon stand out is that there are no term limits, and you keep 100% of the Bitcoin upside. The Bitcoin upside, kids, is fully yours to custody however you want, wherever you want, with no risk of forced liquidation. If you've been sitting on a pile of home equity and are eager to invest in Bitcoin, this may be the product for you, my little captains. Visit joinhorizon.com to see if you qualify and get started. Their team of 200 IQ genius experts will work with you one-on-one from start to finish. They will answer any questions that your little brain has. Transform your dormant home equity into Bitcoin today with Horizon and don't party too hard. Class dismissed.